Tuesday, November 5th, 2024, Monaco 64, home of alternative economics and contrarian views. Well, we're going to look at why the bond vigilantes could be the big winner today. Yes, U.S. presidential election. For the last few elections, they've been saying that it's the most important one ever. But I think this one is pretty important. And why? Well, because I think what we have is not the United States of America, but the disunited States of America. And according to Neil Howe, who wrote the book The Fourth Turning with William Strauss over 20 years ago, the fourth turning is here. And there's a big crisis ahead in the next few years up until the early 30s. And I think he is right. But I think what's going to accentuate the crisis is not just political and social division, but is the cost of credit. And that's why we're going to look at the bond market, and we're going to look at the debt as well. And we're going to look at, if it matters, who wins today. And of course, we have to look at Congress as well, how that's divided amongst the parties. That will be very important as well. But I have a feeling it won't really affect too much the bond market and the bond vigilantes. Before I start, I like to say I'm in the United Kingdom. I am neutral in this because this is for Americans to decide today who they're going to elect. So I'm not going to take sides. The only thing I hope is that there isn't a big crisis that involves violence and acrimony. But that's not guaranteed, unfortunately, because the last time you had a fourth turning and the winter happened was during the Great Depression, and then that ran into World War II. Prior to that, it was the Civil War. And prior to that, it was the U.S. Revolutionary War. And I highly recommend the book here. You don't have to read Neil Howe's and William Strauss' first book, The Fourth Turning, to learn about these socio-economic cycles that happen. Every seculum, a seculum is 80 to 100 years, which is a long human life. Anyway, Rudy and I are earlier today, so it's 7:02 a.m. London time. For some of you in the States, well, you'll probably be watching this later. It's just November 5th, so I wish you all the best in the U.S. When I think about the U.S. and I think about any country, and I've lived in the U.S. when I went to university, and I've been living in the U.K. for 32 years. I grew up in Brazil. I love all the countries I lived in. All the people are always nice everywhere. The only problem is the government, right? It's the old saying. I love my country, but I hate my government. So let's hope things get better in terms of the government. But I wouldn't hold my breath. So why are the bond vigilantes so important? Well, I don't want to sound repetitive, but for those of you who are here for the first time, Bill Clinton had an advisor in the early 90s, James Carville, I think his name was, and he was asked who he would like to come back as if he could choose how he would be reincarnated, and if he believed he'd be reincarnated. And he said, the bond market. And he was asked why, and he said, well, because they have a lot of power. And the bond market is much bigger than the stock market. And it's where the smart money is. And I'm not trying to be pretentious here, but that's, the stock market is more for amateurs in general. So the bond vigilantes, they were kind of asleep from around the early 90s when Clinton came into power up until, I would say, 2020, 2021. Then they've woken up again. And who are the bond vigilantes? Well, they are the investors, speculators, fund managers that punish the government for profligate fiscal spending, punish the central bank for very loose monetary policy. And since the early 90s up until recently, 2020, the bond vigilantes were nowhere to be seen. And why? Is it because the debt went down? Is it because central banks became a lot more responsible? Not really. It's just that the cycle for interest rates were still down. Interest rates topped back in 1981 when the 10-year yield was above 15% and bottomed in 2020. I think it was in March of 2020 at around 0.3. So it was 40 years. And if you go back from 1981 to 1941, 42, it's the same cycle. The 10-year bottom below 2%, just around the time after Pearl Harbor, around that time frame. And it went up for 40 years until 1981. So there seems to be a 40-year cycle here. So it's not going to be as easy for government to borrow, deficit spend, and it's not going to be as simple for the Federal Reserve to cut rates and do QE whenever they want. Case in point, the latest rate cut on September 18th. Look at what the bond market, not just the longer end, has done. The yields have gone up. So I think it's going to be worse. It's going to be harder now to borrow money. I still remember back in the 70s and early 80s, and I was growing up. I was only like a young kid and a young adult. But it wasn't as easy to borrow as we can today, and I think it's going to get harder and harder. So what does that mean? I think we're going to see a lot of bankruptcies because there's still a lot of institutions, countries, people that are in debt, and we're going to find that things are going to be a lot tougher. It's not going to be as easy. We're going to have to work for our keep. And of course, that's what we should always do, but we're going to have to work even harder because it's going to be even more difficult to just borrow. And I think it's going to hurt the financialization as well, stock market, bond market, of course, because when yields and interest rates are rising, the value of debt is going down. And it creates a vicious circle instead of a virtuous circle. From 1981 to 2020, yes, there were periods when yields went up, but the trend was down. You had lower highs and lower lows. And what that did, that created the biggest financial asset bubble, I would argue, in modern history that we know of. And that's why stocks and bonds are so elevated. Maybe not so much bonds anymore, but I think stocks are going to follow. Am I saying there's going to be a crash? No, but I think it's going to be. It's not going to be plain sailing anymore. And if we look at the U.S. national debt, we go to the U.S. debt clock. And this is compiled with data from the Congressional Budget Office. So it's what this agency in Congress is forecasting. It's not me. So let's go back to 2020 and see where the national debt was. Well, it was at 29 trillion. And right now, as I speak here on November 5th. It's 35 trillion 972 billion. So let's say it's gone up 7 trillion. And I think that clock here is discounting for the Trump tax cuts to run off, right? From next year. So if we go to the national debt in 2028, 4 years hence, it's not going to be up 7 trillion. It's going to be up about 14 trillion, which is double the amount, as you can see here. And the debt to GDP is going to have ballooned to almost 160% of GDP. And yes, for the last 40 years, people have been warning about the national debt, and nothing has happened. Things have kept going well. And I agree. But one of the big reasons why things were able to, we've been able to keep going, not just the U.S. As a country, as a government in borrowing, but people, corporations, is that yields generally were going down. So you could always refinance cheaper. But now, in my opinion, that's over, and yields are going to keep going up, and it's going to be harder and harder, and it doesn't bode well. So what do you do in this instance? Well, as an investor, as a saver, I think you try to stay out of fiat currency. Of course, you need to have some cash for emergencies, but if you have spare cash, if you're a big saver, I think leaving your balances in the bank or buying debt or bonds could be pretty detrimental to your financial health. I'm not giving financial advice here. I mean, my friend Clive Thompson, who you know of, he would probably advise people to diversify, but he's pretty bearish on bonds as well. So I wanted to I was looking last night at what the Treasury yields did after Trump won in 2016. And I know there are some of you who argue he won in 2020, but let's go with what's happened in reality. So we're going to look at what could happen if Trump were to win today, and we find out right away. And this is only looking back at what happened the first time. It doesn't mean to say it's going to happen. But with the way things are going, who knows? It could be even worse in terms of the rise. But on November 7th, which was the day before November 8th, which was election day in 2016, the 10-year yield was at 1.828%, which is pretty low, isn't it? And then on election day, it closed at around 1.86%. A week later, on November 15th, it was at 2.23%, which is a pretty big move, about 40 basis points. And then 2 months and a week later, on December 15th, it was at 2.60. So it went up almost, almost 1 full percentage point. It was about 80 basis points. So that's a really big move for 2 months and a week. So there's a lot of talk that if Trump wins, he's going to try to reenact the tax cuts that are getting rolled out next year that he implemented. So I think it could be, we could see a big spike in yields. But I wanted to look at as well what happened in 2020 when Biden won the election, right? So I did the same kind of exercise. And you look here, beginning of November 2020, the 10-year yield actually had dropped below 1% to 0.83%. And that, of course, was a combination of a few things. It was a combination of the repo crisis that started in 2019, and the Fed had to reverse quantitative tightening and start QE again. They cut rates to zero, and they massively increased their balance sheet, and they do that by buying bonds, and that's why the yields were down so much. But as I look here on the chart, by the 15th of March 2021, bond yields had more than doubled. They were at 1.72%. And let's see here, by the beginning of 2021, they were already at 1.1%. And that was, of course, with Biden winning, who supposedly, who's a Democrat, and Trump was a Republican. And of course, bond yields have kept going up ever since. And they topped in 2023, just below 5%. And right now on election day, we're around 4.3%. So if Harris wins, there are some who think, of course, the Trump tax cuts will not be rolled in again next year. But and that some people think we're going to have higher taxes. But I think the kind of taxation that the Democrats would bring would hurt the economy, and they would, of course, be spending a lot as well, in my opinion. So I don't think anything would change. And as I said, we are in a different era in terms of the bond market. And that's why I think the bond market and the bond vigilantes are going to win this election. And it's not going to be good for anyone. And that's why being out of debt, having some cash on the side, or even better, precious metals, because precious metals, really, gold and silver, are cash. If you go back over 100 years, the banknote or dollar bill that we today have was just a promise to pay in cash, to pay gold and silver. But I can see why people want to hold cash, and it's one of the reasons why I think Warren Buffett is holding so much cash, because he thinks the economy is going to get worse. Because if the economy was going to get better, he would hold on to his investments. And he's waiting for some kind of crisis, some kind of correction, so he can buy businesses on the cheap. But I think it's going to be a lot harder. And I think there's going to be, just like in the 70s, a lot of capital is going to move on to hard assets. And I think they already started about 4 years ago. And I know it's been a bit frustrating, especially for the miners and a lot of other commodity sector businesses. But I think we're about to take off, because there's so much ephemeral wealth out there that was created by this massive bond market bubble and this cheap credit since 1981, that just a small percentage of that going into hard assets is going to make a huge opportunity. So yes, things are not going to be as great, I would say, but it doesn't mean to say you won't find opportunities or ways to profit. And yes, I agree, we could see a lot of chaos and trouble, especially in the United States, civil unrest. And it's going to be quite, I would say, disturbing for some. But I think we just need to keep our heads down and be the best that we can be as individuals. That's all we can really do. And batten down the hatches. So as I said, Rudy and I are really early today, but let's quickly look at where the markets are. It's 20 past 7 a.m. London time. So we've got spot gold, 27.40. It's up about $4. We're right near the highs. The lows, 27.25. Silver is at 32.60, up 15 cents. Low's been 32.23, and the high's been 62. The Dow futures is up 72 points. The NASDAQ 100 futures is up 57 points, and the S&P is up 11. What about the currencies? Yeah, they're still rising a little bit against the dollar. The dollar's weakened in the last day or so. Sterling is up slightly, so is the euro. Not really that much. And crude oil is pretty much unchanged. WTI is at 71.30. And as I said earlier, the 10-year yield is at 4.3. So, yeah, in the short term, of course, anything can happen in the bond market. We could see the yields drop after the election, like tomorrow. But I think in a month's time, they will be higher. Yes, I could be wrong, but my feeling is that, yields are going to keep going up, and it's going to be really hard to, to keep the everything bubble going. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.